Good afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank Malaysia. David Kuo is founder of the Smart Investor out of Singapore, is our guest today. David, good afternoon.
Hey, selamat tengah hari, Brian.
Now, David, I'm going to come back to you, but first, we're going to look at how regional stock markets have performed and also cryptocurrencies. We start with Bitcoin. It's at 30,267.6. It's up 0.16%. Ethereum is at 1,799.35. It's up 1.16%. Now, looking across the regional stock markets, it's a mixed bag. The SGX is down 0.43%. The KLSC is down 0.61%. The Shanghai is down 0.49%. The ASX All Ordinaries is down 0.98%. Bucking the trends, we've got the Nikkei, which is up 0.45%. The Hang Seng is down 0.2%. And rounding up the numbers, we've got the Kospi, which is down 0.23%. Now, I stand corrected. It's mostly red today. Why is that? Because earlier in the day, it was pretty much green.
Yeah, well, I think we'll let you off there, Brian. I think it's sort of marginally in the red. I don't think people should get too excited or disappointed when the markets are down about sort of 0.5% here and there. I think we're going to be living with this for a while. Markets will go up just as they did in the US last week. They went up, then they went back down again. And we'll be getting this flip-flopping for a while as people try and assess what is going on in the global economy. And I think that really is the crux. I mean, 1 minute they'll say that, oh, it looks as though inflation is more or less under control and everything will be fine. The Fed will be cutting interest rates fairly soon or not hiking them as much. And let's all pile into the market. Then suddenly another piece of data comes out that says, oh, inflation is actually sort of back in the mix again, and so let's all pile out of the market because the Fed's going to increase interest rates. So we're going to be getting this for a while, and I think for income investors like myself, Brian, it is salad days, really. I mean, it is going to be a great time because when the market is down, I get to buy my income stocks at a cheaper price. When they go back up again, I'm not out there to sell, but I'm just sort of waiting for the next crop of dividends to come in.
Now, David, I want to get you to break down the whole stagflation story. We are bracing ourselves for stagflation for the first time since the 70s. What's causing all of this for a start?
Okay, I mean, first of all, stagflation should never exist because if you have a look at economic theory, when the economy is growing and it is growing reasonably well or quite quickly, prices tend to rise. And when the economy is in the doldrums or it is slowing down, prices tend to fall. So you shouldn't really get a slowing of the economy and rising prices at the same time. Of course, people will point to things like the jump in oil prices, the supply chain disruptions, and they say that, you know, that is really the cause of the inflation at the moment. But we have to go back to the 1970s, and you're right to go back to the 1970s because it has been almost 50 years since we have seen stagflation, where we get a stagnant or slowing down of the economy and price rises at the same time. And we need to turn to a guy called Milton Friedman, who was a Nobel Prize winning economist. And he said that forget about what is causing inflation. Back in the 70s, it was the oil shock when oil prices went up. Today, it is oil, part of it, food price inflation, and also supply chain disruptions. But he said, forget about what is causing the inflation. I mean, that is a nice narrative to have. But he said, it is just simply too much money, too much liquidity in the market, chasing a limited supply of goods. So what he said was, if you want to cure inflation, if you want to stop the inflation from happening or to slow down the rate of inflation, you have to drain liquidity from the market. In other words, you need to raise interest rates. And in the case of the Fed today, quantitative tightening. You need to pull back all of that cash that you printed over the last, 2 decades almost into the market. If you drain that, then you will be able to bring down inflation. If you don't do that, then you will have problems. We only have to turn to Turkey to see what is happening. Inflation rate at 70%, and what is the Turkish central bank doing? They're cutting interest rates and trying to sort of grow themselves out of inflation, which is really a nonsense.
Okay, and so the thing is, this is the dilemma that the Fed is facing, right? So there is such a spread between the real rate of inflation, which is expected to be above 8% again for the most recent period, and the funds rate, which is a significant spread. So they have no choice but to raise interest rates, and they've telegraphed June and July for half a percentage point for each time. Now, at the same time, they run a risk, obviously, of choking off the economy. This is not a good spot to be in.
Well, it isn't a good spot to be in, but the Fed has no choice. The Fed is not there to spur economic growth. That is the problem for the administration, the Biden administration in the US. And it is the responsibility of all the governments. That's what they're elected for. The Fed is appointed to control inflation. That is the only job they have. And as a result of that, the Fed has no choice but to drain all of that money that has been pumped into the US economy, which has infiltrated the rest of the world, and they have to drain that liquidity out from the market. So just prepare yourself. But going back again to the 1970s, it took nearly 10 years for inflation to return to any sense of normality in the States. So I think we need to prepare ourselves for, if not 10 years, then certainly a bit less, a pretty long period where we're going to have to sort of live with relatively high inflation. And maybe the best thing that the Fed can do is to admit that they're never going to get inflation back down to 2% in the near term. And maybe they need to raise their inflation expectations and say something like 4 or 5% is more realistic than 2%.
Then, David, what should we do as investors?
Well, first of all, be an income investor, because I think what we're going to be seeing at the moment is that there will be many companies that will not be able to survive higher interest rates and the draining of liquidity from the market. So I go back to the old rules of the income investor, regardless of whether we have inflation or not inflation. In other words, look for companies that produce the goods and services that you can either easily afford or can't do without. Look for companies that have low levels of borrowings, low levels of gearing. In other words, they haven't borrowed a huge amount of money, because if they have borrowed a lot of money, those interest rate hikes are going to hurt them. And of course, the third thing really is to look for companies that have pricing power. So the three things are companies that produce goods and services that you can either easily afford or can't do without. Companies with relatively low debt, because if they have high debt, most of that cash that they generate will be used for servicing debt, and that's not going to come into my pocket, Brian. And the third one is pricing power, and companies that can raise prices in the face of rising inflation, because they need that pricing power in order to generate the cash, in order to reward investors like myself.
Now, David, as always, thank you very much for your sagely advice.
Thank you.
Now, we've been speaking to David Kuo, the founder of the Smart Investor out of Singapore, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on Rajhi Bank's social media platforms. Please like and subscribe our various platforms. Thanks for tuning in.